Good morning, everyone, and welcome to the market opening bell for Wednesday, 12th August, your 10-minute guide to the stock market. The Hang Seng Index opened 61 points higher and briefly reclaimed the 26,000 level, peaking at 26,060 before quickly reversing lower and closing near the day's lows at 25,652, down 284 points or 1.1%. Total market turnover reached 210.9 billion Hong Kong dollars. The Hang Seng China Enterprises Index finished at 8,528, down 93 points or 1.1%, while the Hang Seng Tech Index closed at 4,824, off 95 points or 1.9%. Southbound funds recorded a net outflow of $1.376 billion. CITIC Securities, Xiaomi, and Minimax attracted net inflows of 556 million, 403 million, and 122 million respectively, while Alibaba, Kingboard Laminates, and Lingbao Gold saw net outflows of 361 million, 234 million, and 188 million. Technically, the Hang Seng Index briefly regained the 26,000 level before losing it again, and it also breached both the 10-day moving average at 25,811 and the 250-day moving average at 25,742, forming a bearish engulfing pattern. The index is expected to retest support at 25,400. A break below 25,400 would open the way for the next support at the 100-day moving average of 25,193. A-share markets opened lower by between 0.1% and 0.4% and traded mixed through the day. The Shanghai Composite fell 32 points or 0.8% to close at 3,934. The Shenzhen Component dropped 57 points or 0.4% to 14,259, while the Chinex Index rose 11 points or 0.3% to 3,549. Combined turnover on the Shanghai and Shenzhen markets totaled 2.32 trillion yuan. Unitree Technology officially launched its online subscription for the STAR market on 10th August. According to Shanghai Stock Exchange data, the effective number of online subscription accounts reached 9.7846 million, covering 53.637 billion shares and producing a preliminary online allocation rate of 0.0120644%. with the initial effective subscription multiple at approximately 8,288.82 times. The issuer and sponsor activated the clawback mechanism, transferring 3.236 million shares from the offline to the online portion. After the clawback, the final online offering size stood at 9.707 million shares, representing about 30% of the issue size after deducting the final strategic placement. And the final online allocation rate rose to 0.0180979%. Market participants estimate that securing an allocation in Unitree will be significantly harder than in the earlier Chang's CXMT offering. Brokerage calculations indicate that the average first-day gain for A-share IPOs this year has reached 276.04%. Assuming Unitree matches that average, one lot of 500 shares could generate paper profits exceeding 200,000 yuan. If measured against the year-to-date STAR market average first-day gain of 466.61%, potential profits per lot could surpass 350,000 yuan. The central parity rate of the renminbi against the US dollar was set at 6.79, down 16 points from the previous day. The People's Bank of China recently issued its 15th five-year reform and development plan, accompanied by 9 related action plans for specific areas. The documents reiterate the need to keep the renminbi exchange rate basically stable at a reasonable and balanced level, and to build a high-quality technology board in the bond market. Several Hong Kong-listed companies released results. China Tower, delivered a distinctive interim pattern of slightly lower revenue but sharply higher profit, reflecting the release of earnings once a high depreciation period ends. Revenue for the period fell 1.8% year-on-year to 48.693 billion yuan. Operator business revenue declined 5% to 40.357 billion yuan, with tower business revenue down 6.7%, while indoor distribution rose 9.2%. EBITDA came in at 30.252 billion yuan, down 11.6% for an EBITDA margin of 62.1%. Operating costs fell 8.3%, driving net profit up 30.1% to 7.489 billion yuan. A large batch of tower assets transferred from the three major operators in 2015 carried mostly 10-year depreciation lives. From October 2025, those assets have progressively reached the end of the depreciation schedules. Management's earlier static estimate pointed to a reduction of more than 8 billion yuan in full year 2026 depreciation expense. After allowing the subsequent inspection and maintenance costs, the saved depreciation flows directly into net profit and has underpinned the step change in earnings. Earnings per share were 0.4284 yuan, emphasizing shareholder returns, and after considering profit, cash flow levels, and future funding needs, the company declared an interim dividend of 0.19122 yuan per share, equivalent to a payout ratio of about 45%. Management aims for steady growth in full-year dividends per share to create greater value for shareholders. At the end of June, the number of tower sites stood at 2.172 million, up 23,000 from the end of the previous year. In the emerging non-operator businesses, the smart connections segment is converting communication towers into digital towers, leveraging elevated vantage points to provide video surveillance and data sensing services to government departments in environmental protection, land and forestry. Smart connections revenue reached 5.332 billion yuan in the first half, up 12.8%. Drawing on the power supply advantages of its towers, the company is also expanding electric vehicle battery swapping and backup power services. Energy business revenue rose 17.3% to 2.591 billion yuan. The three major telecom operators remain both major shareholders and core customers, so future commercial price renegotiations could compress margins and continue to represent a structural vulnerability for China Tower. Hong Kong Electric Investments reported interim results for the 6 months ended 30 June 2026, showing steady revenue growth, stable net profit, and an unchanged dividend. Revenue rose 6.7% year-on-year to 5.939 billion Hong Kong dollars. Electricity sales volume increased 2% compared with the same period last year, mainly because of relatively mild weather and improving economic conditions that lifted commercial customers' demand. Net profit edged up 0.2% to $1.003 billion, or $0.1135 per share. The interim dividend was held at 15.94 Hong Kong cents, the same as a year earlier. Tingyi posted interim results for the 6 months ended 30 June 2026 that show a modest recovery in revenue and solid profit growth. Group revenue reached 40.545 billion yuan, up 1.1% year-on-year, and emerging from the 2% full-year decline recorded in 2025. Instant noodle revenue rose 2% to 13.733 billion yuan, accounting for 33.9% of the total, while beverage revenue increased 0.7% to 26.541 billion yuan. EBITDA grew 3.6% to 5.645 billion yuan. Overall gross margin improved 1.3 percentage points to 35.8%, helped by product mix optimization and lower costs for key raw materials such as palm oil and PT resin. Net profit rose 7.1% to 2.433 billion yuan. After excluding one-off asset activation effects, adjusted profit grew 15.2%. Earnings per share were 43.16 cents. No interim dividend was declared. In 2025, the company raised its full-year payout ratio to 100% with abundant free cash flow and no major capital expenditure pressures. The market expects the high payout policy to continue at the end of 2026. Traditional fast-moving consumer goods face intensifying pressure from the health-conscious trend. Tingyi has accelerated the rollout of zero-fried healthy noodles, and on the beverage side is expanding sugar-free teas, functional drinks, and exclusive pack sizes for instant retail channels such as Meituan Flash Purchase and Ele.me, aiming to reclaim market share and competition amid competition from non-food spring and emerging bottled tea brands. China Literature released its 2026 interim results characterized by a sharp drop in reported profits, steady core operations, and strong growth in new segments. First half revenue rose 10.7% year-on-year to 3.53 billion yuan, driven mainly by a 40.3% surge in IP operations and other income. Online business revenue fell 7.3% to 1.84 billion yuan, largely because a higher portion of lower monetization free reading content within the WeChat ecosystem reduced overall conversion efficiency. The platform still attracted 240,000 new writers in the first half, and among newly signed authors with annual income exceeding 1 million yuan, 57% were under 30, helping sustain the vitality of the underlying IP supply chain. IP operations and other income jumped 40.3% to 1.691 billion yuan. Within that, short drama and AI comic drama related revenue saw 2.3 times to 430 million yuan, accounting for 27% of IP operations revenue. Under the IP plus AI strategy, the company has fully opened an efficient visualization pathway for its IP. The proportion of short drama has reached 4 times the market average. 46 AI comic dramas surpassed 100 million views and 367 surpassed 10 million views. China Literature launched the Qi Dian Theatre platform domestically and Toon Scroll overseas. Expanding IP influence has also supported steady, sustainable growth in derivatives, with GMV hitting a new high of 780 million yuan, up 60%. Gross margin improved 0.2 percentage points to 11.1%, reflecting a more favorable product mix with higher margin IP licensing and short dramas. Profit attributable to shareholders plunged 84.1% to 135 million yuan, mainly because of two non-operating items: a one-off tax and late payment surcharge of 300 million yuan paid by a subsidiary, and a high base that included 512 million yuan of deemed disposal gains in the same period last year. The company maintained its practice of not paying interim dividend. At the end of June, net cash stood at $986 million, approximately 6.72 billion yuan, providing ample reserves. Tencent Music reported second quarter results that exceeded revenue expectations while showing slight pressure on margins. Revenue rose 5.8% year-on-year to 8.93 billion yuan, above the consensus estimate of 8.81 billion yuan. That's slower than the 7.3% growth recorded in the first quarter. Service segment revenue grew 11% to 7.61 billion yuan, supported by marketing and consumer services. Membership service revenue increased 8.1% to 4.79 billion yuan. The early acquisition of the online audio platform Himalaya contributed 407 million yuan and helped lift overall second quarter growth. Social entertainment and other revenue fell 16% to 1.33 billion yuan under the combined impact of live streaming, regulatory conditions, and proactive platform strategies adjustments. This segment's profit contribution continues to recede from the core. Non-IFRS earnings per American depository share were 1.7 yuan, higher than the 1.66 yuan recorded a year earlier and above the analyst consensus of 1.64 yuan. Gross margin edged down 0.2 percentage points to 44.2%, mainly because of higher costs for lower margin offline performances and the expansion of the long-form audio content library. Tencent Music ADR closed sharply lower, plunging 11.9% and finishing 11.3% below its Hong Kong share price. Prospects for the reopening of the Strait of Hormuz appear increasingly uncertain. Oil prices continue to climb and U.S. equities fell for a second consecutive session. The Nasdaq Composite declined 0.6% to close at 26,445. Both the S&P 500 and the Dow Jones Industrial Average slipped 0.3%, finishing at 7,728 and 53,791 respectively. The fixed fear gauge eased 0.18 points or 1.2% to 15.28. The Nasdaq Golden Dragon China Index, which tracks U.S.-listed Chinese companies, dropped 197 points or 2.9% to 6,532. Most sectors finished lower, with communication services leading the declines. Honeywell tumbled 5.3%, the steepest fall among Dow components, while Home Depot rebounded 1.1% to post the strongest performance in the blue chip average. Heavyweight technology stocks traded mixed. Apple and Amazon fell 1.1% and 2.1% respectively, while Alphabet dropped 3.8%, its fourth decline in 5 sessions since Google announced a restructuring of its artificial intelligence division last week. SpaceX retreated 3.9% and Meta rose 0.7%. Nvidia was little change, edging down just 0.02%. The company said it has partnered with 6 major financial institutions to raise more than $500 billion in third-party capital for AI infrastructure development. Among those institutions, KKR surged 6.9% to become the best-performing stock in the S&P 500. Apollo gained 6.3% for the third-largest advance. Blackstone advanced 3.9% and both BlackRock and Brookfield also rose, while Goldman Sachs ended little change. US-listed sportswear brand On reported disappointing sales last quarter, sending its shares plunging 20.3% and tracking Nike and Lululemon lower by 1.9% and 1.7% respectively. CoreWeave reported second quarter results that beat market expectations on the back of robust demand for cloud computing. Revenue more than doubled year-on-year to $2.58 billion from $1.21 billion, exceeding the consensus forecast of $2.55 billion. Net loss per share widened to $1.14 from $0.6 a year earlier, yet still came in better than the expected loss of $1.46. The company's revenue backlog as of 30 June rose to approximately $104 billion from $99.4 billion at the end of March. Its shares jumped nearly 10% in after-hours trading. Existing home sales in the United States fell 1.7% month-on-month in July to a seasonally adjusted annual rate of 4.06 million units, down from 4.13 million in June and slightly worse than the market expectation of 4.05 million. The larger than expected decline reflected the ongoing impact of higher home prices and mortgage rates on purchasing activity. The median home price slipped to $434,100 from $442,800 in the previous month, but remained 2% higher than the $425,700 recorded a year earlier, and marked the highest July level on record. Our stock pick today is METiS TechBio, stock code 7666. METiS TechBio, known as the world's first AI-powered drug delivery stock, primarily engages in artificial intelligence-enabled nanomaterial innovation, focusing on the delivery and application of payloads across various living organisms. Nanomaterials enable targeted delivery to specific organs and tissues and can interact directly with cells, offering immense potential to address diseases at the molecular level. The group has independently developed NanoForge, the world's first AI-driven nano delivery platform, which features the currently largest scale lipid library of tens of millions of LNPs globally. Building on NanoForge, it has created 4 core solutions: AI LNP and AI Nano Delivery System Design Platform, AI RNA and AI mRNA Sequence Design Platform, AI Protein and AI Protein Design Platform, and AI TEM and AI Small Molecular Formulation Design Platform. The group has already achieved the capability for precise targeted delivery to 8 key organs or tissues, including the liver, lungs, muscles, and immune cells. It has made breakthrough progress in overcoming multi-organ and multi-tissue targeted delivery challenges, thereby creating drug development opportunities for tumors, metabolic system diseases, autoimmune diseases, and neurodegenerative diseases, while also offering possibilities for organism-level anti-aging applications. The group recently announced that its self-developed AI-TEM artificial intelligence formulation innovation platform will be locally deployed at Jiangsu Hengrui Medicine to accelerate the efficiency of drug formulation development. This collaboration marks the continued realization of an external commercialization closed loop for the NanoForge-driven AI-TEM AI formulation innovation platform, and initiates the process of NanoForge empowering next-generation intelligent R&D infrastructure. AI-TEM is powered by METiS TechBio's proprietary AI nano delivery platform, NanoForge, as its technical engine, and employs proprietary algorithms for drug formulation design and optimization. Through quantum chemistry and molecular dynamic simulations, the platform predicts interactions between drugs and excipients, generating optimized solutions for various dosage forms to improve drug solubility, permeability, and bioavailability, thereby achieving ideal pharmacokinetic profiles. In the METiS-004 project, the first AI-enabled formulation new drug in China to complete phase 3 clinical trials, AI-TEM undertook the modeling and predictive analysis for dosage form development, shortening the preclinical formulation optimization cycle from the industry average of 1 to 2 years to within 3 months. From project initiation to completion of phase 3 clinical trials, METiS-004 took only 38 months, significantly enhancing drug R&D efficiency compared with the industry average. According to data from Frost & Sullivan, the global market for nanotechnology-based Pharmaceuticals grew from $187.5 billion in 2020 to $222 billion in 2024, representing a compound annual growth rate of 4.3%, and is projected to reach $585.4 billion by 2035, with a compound annual growth rate of 9.2% from 2024 to 2035. Similar technological advances are also creating opportunities beyond human therapeutics, including in animal health. According to Frost & Sullivan, the animal health products market reached $52.2 billion in 2024 and is expected to grow to $131.5 billion by 2035, representing a compound annual growth rate of 8.8% from 2024 to 2035. The recommended buy-in price is $11.80, with a target of $30.20 and a stop loss at $11.20. I do not hold the above stock.